The federal district court presiding over the Google antitrust case finally reached a ruling. Hands down, Google won. Large tech companies like Meta, Google, Amazon, etc. are spending combined over $300 billion in AI-related CapEx. What we just don't know is what the return on investment is going to be. There are some critics out there who are arguing if it turns out that the returns, at least at first, are disappointing, and we will go through a painful digestion period just like in 2001. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending September 5th, 2025. First, the stats. This week, the S&P was flattish, and NASDAQ was up around 1%. But frankly, both indices are just treading water and just seem to be consolidating at relatively high levels. Before we start, I want to correct a mistake I made in last week's Weekly Wrap. I was discussing the Fed and stated that the Fed was created by a constitutional amendment. Some listeners commented that I was wrong. And they're right. The Fed was not created by a constitutional amendment, but by the Federal Reserve Act of 1913. I stand corrected. In economic news, employment data has been coming in weaker than expected, which has fed speculation that the Fed will cut rates this month. The 10-year Treasury yield is now below 4.1%. And this news has created a rally in housing-related stocks. In tariff news, is there a week without tariff news? The U.S. Court of Appeals for the Federal Circuit rejected President Trump's tariffs enacted through the International Emergency Economic Powers Act, aka IEEPA. The vote was 7-4. President Trump, of course, is appealing, and I'm sure the Supreme Court will take the case. So don't expect a decision until December at the very earliest. Now, with respect to the Supreme Court, the 6th Republican majority has paid a great deal of deference to presidential powers. So if I had to bet, I would bet that the Supreme Court will uphold the tariffs. But you never know. Anyway, President Trump has backup plans to enact most of the tariffs under alternative existing legislation. In important antitrust news, on Tuesday, the federal district court presiding over the Google antitrust case finally reached a ruling. Hands down, Google won. My guess is that the explosion in AI and the resulting assaults on Google's search business from AI competitors led the judge to conclude that the case, in a sense, was stale. The judge certainly intimated that in his opinion. The facts had simply changed while the case was litigated. Yes, the judge ruled that Google cannot enter into exclusive search deals. However, most importantly, it will not be required to sell Chrome. And it can still make the $20 billion annual payment to Apple so that Google is the default browser on all Apple products. This result was much, much better than expected, and both Google and Apple were up nicely after hours. This was without question a victory for the status quo. Now, that does not mean that Google does not now face formidable competition from other AI competitors. But at least it won't have to fight a two-front war. By the way, this case has gone on for quite a few years now. The case was filed in October 2020, and prior to this, commentators were expecting a much harsher remedy. Certainly, the judge's prior rhetoric indicated that it would go that way. Which brings me to Apple. The stock has had a difficult year. There have been 3 overhangs, and 2 have just left the building. Apple manufactures almost all of its products in China, and the Trump administration had been demanding that it move production to the US, which is frankly impossible in any foreseeable time frame. Thus, Apple was totally captive to trade negotiations between the US and China. And the Google antitrust case was a problem, as Google pays Apple $20 billion per year to make Google's browsers a default browser on Apple products. Both of these overhangs have gone away. The US is exempting Apple products from tariffs, and the Google lawsuit, as I had said, went Google's way. Now, the remaining overhang, Apple is AI challenged. It is just unclear what its AI strategy actually is. But that is the long-term problem. At one point, Apple was down double-digit percentage this year. But as of now, it is almost flat for the year. Apple does need, however, an AI strategy to get its stock really moving again. In other news, on Tuesday, Kraft Heinz, a $32 billion market cap company, announced that it is splitting into two. One company will include shelf-stable meals and be home to brands such as Heinz, Philadelphia, and Kraft Mac and Cheese. The other company would include Oscar Mayer, Kraft Singles, and Lunchables. Now, why do I bring this up? Because M&A goes through fads. The funny thing, although maybe it's not so funny, is that the investment bankers who advised these mergers to begin with later become the bankers to undo them. It's good to be an investment banker. First, they buy them up and create conglomerates, and then they break them down. The Kraft Heinz merger in 2015 was actually the brainchild of Warren Buffett. The idea was a larger company would command more shelf space in supermarkets. And guess what? It didn't work. And not just for Kraft Heinz, but for other food conglomerates as well. Kellogg's is already split into two companies. One final important note. Warren Buffett said on CNBC that while the merger has not been great, he does not support the breakup. And since Berkshire owns, get this, 27.5% of the company, this demerger may not happen. When the news of the demerger was announced, the stock was up on day. But when the Buffett news came out, the stock was down on day. In earnings reports, Salesforce, the software company, issued disappointing guidance. Salesforce was down almost 6% after hours. For the quarter, EPS was $2.91 versus $2.56 last year, and versus a consensus of $2.78. So a beat. And revenue came in at $10.24 billion, slightly better than the expected $10.14 billion. But third quarter revenue guidance was slightly below expectations. Now, prior to this week, Salesforce was down 23%. And that's partially because revenue growth has not been great, but also because investors are really worried about the impact of AI on software companies. Well, Salesforce did itself no favors when they reported Wednesday night. When your company is under a thesis cloud, a bad earnings call cannot happen. There is a lesson here. When a company is doing well and beloved and issues conservative but perhaps disappointing guidance, most investors just shrug it off and figure the company will beat that guidance anyway. But when a cloud of fear hangs over a company, like in the case of Salesforce, the same exact guidance is not taken well. And here's the overhang. Because it's so relevant, I'm going to quickly repeat something I said on last week's wrap. Software company moats are eroding. Software companies have great business models. They charge a monthly or quarterly or annual fee for their services. So they generally don't sell the software up front, but charge a subscription fee. This is called SaaS, S-A-A-S, software as a service. And investors love it, partially because it makes it easy for analysts to model the future growth of these companies, and partially because of the subscription. Software companies have created enormous moats around their businesses. But AI is potentially a threat. Because of AI, the cost of creating software appears to be plummeting. New companies are emerging that charge much less as compared to the incumbents. And so the moats around the traditional companies don't seem quite so moaty anymore, at least for now. And that is why iconic software companies like Salesforce, Adobe, Akamai, and ServiceNow are down for the year. Salesforce's great history, but current issues, are reflected in Salesforce's stock charts. Since it went public in June 2004, the stock is up almost 6,000%, which is many, many times better than the overall S&P 500's performance. But the 5-year chart shows the stock is actually down a few percentage points over that 5-year period of time. That is not to say that Salesforce is just standing there like a potted plant. It is incorporating AI into its products, but it's early, and Salesforce is now a show-me stock. In sum, Salesforce has been public for 21 years. For the first 16, the stock was a monster. The last 5 are flattish. That says a lot. And just to highlight how investors now love hardware over software, which believe me is a huge switch, Broadcom reported Thursday night, one day after Salesforce. Now, Broadcom develops custom chips for Google and other cloud companies, in addition to networking parts needed to tie AI chips together. Prior to this week, Broadcom stock was up around 35% this year. Now, Broadcom reported earnings per share of $1.69 versus $1.24 and versus $1.65 expected, so a small beat. Revenue was $15.96 billion versus $15.83 billion expected, so also a small beat. But unlike Salesforce, Broadcom's guidance was fine. The company is expecting for the September quarter revenue of $17.4 billion versus the consensus of $17.02 billion. Now, after hours, Broadcom was up 4.5% after the company announced a $10 billion order from one new customer, which the company would not name. But analysts were speculating that it is OpenAI, and on that speculation, Broadcom was up 12% on the open on Friday. Now, the last company I want to mention is Lululemon. The stock is down over 50% this year. They reported Thursday night, and the news was not good. Same-store sales were down 4%. It lowered guidance for the year to around $12.85, which is well below the consensus of $14.45. The problems with Lululemon extend far beyond the impact of just tariffs. Fashion trends in its business have changed, and Lulu has not kept up. Now, even though Lulu is considered more a basics business than trend chasing, a major shift in silhouettes undermined Lulu's numbers. My wife says that skin-tight leggings are out and room to breathe is in. This can be the problem with investing in retailers. When they miss the inflection in fashion trends, and they all do at some point, the business really suffers. And that's the wrap. And now the mailbag. One thing I'd like to address is a question I frequently get, which is, what am I worried about? My answer is that I'm not worried about this yet, but I'm starting to think about it. If you go back to 1999, the internet analysts back then were all pontificating that the internet would conquer the world. And they were right, eventually. But at that time, there was massive investment in that gold rush. Too much too soon, it turned out. And overinvestment largely caused the recession of 2001. By the way, even after that recession was over, tech stocks then did nothing for a number of years. There is something of an analogy to be drawn potentially, and I emphasize potentially, to the current day. Large tech companies like Meta, Google, Amazon, etc., are spending combined over $300 billion in AI-related CapEx. Everyone is chasing AI. Now, I'm the first to admit this is not my area of expertise. But there are some critics out there who are arguing that the current model of building AI is to just keep scaling large language models. And that method, some argue, is beginning to lose steam, such that the new ChatGPT 5.0 that was just released is apparently not much better than GPT 4.0. What we just don't know is what the return on investment is going to be for all this spending. And if it turns out that the returns, at least at first, are disappointing, then investment will slow from the current torrid pace, and we will go through a painful digestion period just like in 2001. And that's the wrap. This last Monday, we dropped an episode where I answered many questions from viewers. And this Monday, we are dropping our very first masterclass on financial literacy. It's jam-packed with information about a whole bunch of investment topics. I think many of you will learn a lot from listening, so please tune in. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses, which we will be releasing soon. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes, as well as the financial literacy masterclasses that we will be posting soon, and Some other surprise goodies we will also be posting soon as well. Check it out. See you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.